We'll be looking at financial statement analysis in case study exams. So by way of introduction, in every case study exams, candidates are presented with accounting information. So the information presented are either accounting information or finance information generally. It normally takes the form of truncated financial statements, frequently referred to as management accounts. So the financial information that comes aside the numerical, aside the data, the chunk of exhibits that are more of notes or a lot of readings, they are referred to as management accounts, extracts from financial statements or summarized financial statements. So we have maybe a 3-year financial summary, 2 years financial summary, or a 1-year financial summary, depending on what the examiner first. But then we always have financial statements to speak to. So it could either be an SFP or an SCI. He has never tested cash flow, but then we're supposed to have cash flow, which is the full tripartite financial statements. Income statement, the traditional balance sheet, and cash flow statement. But then in his 21st editions, he has always tested SCI and income statement. He has not tested the cash flow statement yet. So we are presented with mostly management accounts, that is, that have not been audited. So we have maybe some financial statements that have been audited, but just part of it. So what this slide is saying is that we've never had a full financial statement. That's 3 of them presented in the case study exams. So this is practically to avoid the need to provide unnecessary detailed disclosures that will be required for a full set of IFRS compliant financial statements. So the practicality involves what is relevant. The examiner tries to bring what is relevant to bear and what is needed at that particular exams, and unnecessary disclosure on information is not required for a full IFRS statement to be presented in the exams. That's what he means. So to all extent and purposes, unless otherwise stated, the accounts should be treated as having been drawn up on a rigorous basis by competent financial or finance professionals and suitable for audit purpose. Exactly. So the financial statements presented or management accounts are provided for us to rigorously work on. They have actually been prepared by finance professional. So it's now on the onus is now on us to work on it, audit it, provide our professional skepticism, and that's actually the purpose and intent of those statements. So the basis of preparation is not intended to be questioned unless a specific indication is given to the contrary. So for example, that the accounts have been challenged by auditors. So where the financial statements have been audited by external auditors, then that makes our job easier, since external reviews have been provided and validated the financial statement. So most importantly, except where it's stated as management accounts, the job is not to question the validity and reliability of the numbers, but once we are able to validate that it has been audited by auditors, then we don't need to challenge it. But if it's the other way around, then we have to be sure that the financial statements are being audited. So generally, by way of introduction, in the case study, this is what is presented to us: truncated financial statements, not fully given, because up to now he has not tested the cash flow statement, and I keep saying it so that in case that comes in diet, exactly, you should take note and just be ahead of the curve. So generally, that's an introduction to the financial statement analysis in the case study exam. So we'll be looking at steps in this first section of the Unit 8. What are the steps in financial statement analysis? What steps do we take in analyzing financial statements once provided to us? Okay, so the first step, in order to carry out a thorough financial statement analysis, there are a series of steps we should be able to follow to ensure the procedure is comprehensive, well understood, and complete. So in this material ICAN has given us, we are actually looking at the following headers. We'll be looking at initial analysis, the first bird's view of the financial statement. You have to perform an initial analysis. So the initial analysis is not going into intricately. You are just scanning through. You just look at one or two things to determine what are the components of the financial statement, what are the numbers saying, and you're not going into detail. And after you've done the initial flash snapshot and a bird's view of the financial statements, you now do a detailed analysis, and that involves ratio analysis and looking at key financial statements, the income statement, the statement of financial position, and also using financial statement analysis in that same case study. So before developing these steps further, we need to understand that the development of this financial statement analysis skill is a lengthy process. So it's not a sharp process. It's something that is developed over time. Financial statement analysis is not just during the exam. You have to bring to bear your working experience, your knowledge of practice of past questions, and all that will need to be integrated together to be able to harness this skill properly. So it's a lengthy process, but as we look at them, we'll understand how to glean and build up this skill very practically. So in terms of how long it actually takes to perform a single piece of financial statement analysis properly, and the number of financial statements which have to be analyzed to fully develop this competency. So to be competent in this, we need to actually perform this over and over again and do it properly. And that's why practice and practice and practice, they say, makes perfect. So it's very important we understand this, and performing financial statement analysis on a single set of financial statement, double, triple, will help develop this competency very practically. Also, reading or auditing someone else's financial statement analysis can be deceptive in terms of how difficult or easy that task is of analysis. So the person must have prepared a financial statement, and you're supposed to audit it. So reading it and auditing it may seem like you are analyzing. No, you are not analyzing. As a matter of fact, people who analyze financial statements or audit it should be able to prepare it first. You'll be able to really know where the nitty-gritties are. But if you don't know how to prepare financial statements and you want to audit it, it will be a bit challenging actually, and it can be deceptive. That's what he's saying here. So reading it and seeing how the process is may not really help you, but then preparing it and also understanding how to analyze it is key. So preparing, then also auditing. It's easy for someone who has worked in financial reporting and moved to auditing to be able to audit, because he knows the preparation process and the auditing process at the same time. So it may be difficult or easy depending on how the task is, very, very practically. Apologies, I just scrolled, I think my hand, okay. So this was where we were. All right, so particularly financial statement analysis and auditing someone else's financial statement can give a false impression that the topic is easy. Yes, that's exactly what we said. So there is no substitute of doing the analysis yourself in order to appreciate the full dimension and complexity of the work. So that's what I'm saying. So being able to prepare, and if you transited a position of financial reporting to auditing, you stand a better chance. That doesn't mean if you've not done financial reporting, you can't audit, but then you stand a better the better chance of understanding how to catch issues on financial statements better, because you've prepared it before. So if you've not prepared financial statement before, the job of auditing it and doing the financial statement analysis yourself is the only way to understand how to analyze financial statement. So doing the analysis yourself, checking the income statement, looking at the bridges, looking at the linkages is very important for you to appreciate the dimension of and complexity that work involves. So it's not small work, but then it's easy if you put more attention and effort to understanding how to analyze it yourself. And nobody will do it for you. Just like nobody will eat for you, nobody will drink for you, nobody can breathe for you. You have to do it yourself. So financial statement analysis cannot be delegated. It has to be done by ourselves by ourselves. And in the case of the exams, the case study exams, it has to be done by ourselves, the candidate in the exam. So take note of that and ensure that you practice financial statement analysis yourself in order to develop the necessary skills and speed. So the more questions you practice, the more you do, the more practical financial statements you see on the dailies, on financial statements on the stock exchange, it will help you harness these skills very properly. I'm always curious when I see financial statements of any company. I pick it and look at the SCI, just initial reviews, and I'm able to, if I'm interested, go into detailed review, not for exams, but just to understand how the company has fared and how to analyze also the financial statement. So this interest will help instigate and also help you with these necessary skills and speed in financial statement analysis. So that's briefly what the steps are. So in summary, you do an initial analysis. We'll be looking at that in detail. We have the detailed one. Then we have using the financial statement analysis in the case study exam. So reading and auditing will not really make you understand how to analyze financial statements, but practicing by yourself, doing it yourself, will enhance your skills and speed. So where you don't have financial statements so much to work on, then past questions will help you really harness that. And I have so much of those past questions that I've done on YouTube. I also attach the solution in the description so you can look at them, download them, print them, and just read and practice once you have the chance. Okay, so that will be the end of these short steps in financial statement analysis. I don't know, before our quiz, do you have any questions? I hope you don't ask any question that will show up in the quiz. Yeah, please go ahead.
You have questions for me? This small introduction.
No, this is not an introduction. We've done introduction. Now we are into steps in financial statement analysis. We don't want it too long. And the case study text is not too long, so it's short, so that you don't slip off. Then we quiz you before we move to the next section. So this section 1 and it's short. So we're going to take a quiz, and if it's very short enough, it shows that you've comprehended what we just said and you'll be able to score 100% in the quiz.
Okay, let's see.
All right, you don't have any question.
Okay.
We just go to the quiz. Is that what you mean?
The only question I have is that when the normally the first questions that come out, the financial statements are always audited, but how does it show that it's audited? And sometimes when they are doing what do they call those things? Is it reservations or what do they call those things? In the second part, yeah, some people say it is not audited. That it's not audited. How does it show that it's not audited?
Oh, okay. You want to know whether the financial statements are audited or not, whether from the pre-seen or from the unseen.
Yes.
Right?
How does it? Yes. How do you take note of it? How do you know?
Okay.
What does it show?
Okay. So from the header, you will see that it said management account. So immediately you see anything header management account, just know it's not audited.
Account. Okay. I understand.
Yeah, but if you see financial statements, just know it's audited.
Okay. All right.
Yeah.
Thank you.
Exactly. All right. You're welcome. Okay. Nice question. So let's go. Number 1, what is the first step in conducting a thorough financial statement analysis? A, ratio analysis. B, initial analysis. C, case study application. D, final review. What is the first step in conducting a thorough financial statement analysis? We have only J on the call.
Analysis.
Okay, so B, final answer.
Did you say B? And B is the answer.
Final answer.
B is final answer. Cannot be initial analysis.
Okay, yeah, initial analysis is B. All right, we'll see. Which of the following is not explicitly mentioned as a step in financial statement analysis? A, initial analysis. B, ratio analysis of key financial statements. C, forecasting future financial trends. D, using
C.
financial statement analysis in the case study exam. That was fast.
C.
You're sure? C?
Yes. Yes.
Okay. All right. C. Number 3, why is reading or auditing someone else's financial statement analysis potentially misleading? A, it makes financial statement analysis seems more complex than it actually is. B, it can give the false impression that financial statement analysis is easy. C, it eliminates the need to conduct analysis independently. D, it provides a comprehensive understanding without practical application. Why is
C.
reading or auditing someone?
C.
C?
Yes.
C,
Why is
why is reading or auditing someone else's financial statement analysis potentially misleading? It makes financial statement analysis seem more complex than actually is.
No, C.
It eliminates the need to conduct analysis independently. Final answer.
Yes, please.
C. Okay. C. What is emphasized as the best way to develop competency in financial statement analysis? Reading textbooks on financial financial analysis, memorizing key financial ratios, practicing the analysis yourself, attending lectures
the analysis yourself.
Okay. Final answer.
Yes, please. C.
C. Okay. And finally, why is financial statement analysis considered a lengthy process? It requires analyzing multiple financial statements over time. It is only useful for expert accountants. It can be done quickly with the right software. It is a fixed process with no need of adjustment. Why is financial statement analysis considered a lengthy process?
A, please. A.
It requires analyzing multiple financial statements over time. Final answer.
Yes, please.
A. Okay, that's good. That was fast. All right, let's do it. Drum roll number 1. Okay.
Hey, I got it here.
Hey. Yeah, you got it. B. I got correct. What is the first step in conducting a thorough financial statement analysis? Initial analysis. Explanation.
Yeah.
The first step in a comprehensive financial statement analysis is initial analysis. We set the foundation for deeper investigation. Very good, very good, very good. Okay, good one. So let's go. Nice start. Which of the following is not explicitly mentioned mentioned as steps in the financial statement analysis? She got it. C. Correct.
Yeah.
Forecasting future financial trends. While forecasting is useful in financial analysis, it is not explicitly listed as a step in the study text. Okay. Why is reading... she failed this one. Why is reading or auditing someone else's financial statement analysis potentially misleading? You picked C. C is wrong. It eliminates the need to conduct analysis independently. It does not eliminate the need of independent analysis. Instead, self-practice is strongly encouraged. So the answer is B. It can give the false impression that financial statement analysis is easy. Exactly. So what's the explanation? When students read someone else's financial analysis, they may think it's simple, but performing the analysis themselves is much more complex. Exactly. Exactly. Now, we said it in the case study, in the explanation. I'm sure you skipped it. Okay, so I'm a bit happy at least you're not scoring 100%.
My goodness.
I know now. I know you are out for me today. You want to score 100%.
Oh my
Number
goodness.
4. Oh, number four. She got it. What is emphasized as the best way?
I can't believe it. You should be happy that we are getting it.
I'm happy you score 80, 60. Not you can't. I don't want you to be scoring 100. I feel like I'm not setting the questions very, very well. You know. Exactly. So, what is emphasized as the best way to develop competency in financial statement
Accounting.
analysis? Practice the analysis yourself. Exactly. The study text stresses that there is no substitute for doing the analysis yourself to fully understand the complexity and develop the required skills. Exactly. Okay. So, finally, oh, she got it. Wow, 80%. That's good.
Hey, hey.
You are off to a good start. Good one. Why is
Yes,
financial statement analysis considered a lengthy process? It
yes,
requires analyzing multiple financial statements over time. Exactly. Explanation. Mastering financial statement analysis takes time because it requires repeated practice across various financial statements to build expertise. Fantastic. All right. Good job. Good job, G. Well done. But as
Wait, oh,
long as you know,
it analyzes that analyzing multiple financials over time. Yes. But
yeah.
you said some, okay, player classes, okay, to build, yes, of
Yeah,
course.
statements to build expertise. Exactly. Exactly. Nice one. 80% off to a good start. So let's move to section 2 quickly. We are looking at
Yeah.
initial analysis. Initial
Okay.
analysis. Yeah. Okay, so pay attention because of your quiz after the exams, after the question, the lecture. Okay, so initial analysis of financial statements should establish financial headlines. Of the business by way of rapid review. Exactly. So the financial headlines, you want to see what the company is up to and what it has done from a snapshot. So the financial headlines, like if you look at the dailies, they use the headline to capture your attention. So initial analysis talks about that headlines and by way of just a rapid review of the financial statements. The aim of the rapid review is to gain an understanding an assessment of the business as a whole. So skimming through the SCI, the SFP, the SCF, that statement of cash flow, if there is, should not ignore obvious and important features. So you're looking at the gross profit, you're looking at net profit, you're seeing if it's positive, negative, if it's a 3-year financial statement, how has it performed for those 3 years? Then the SCI, the nature of the assets, you're looking at if the company is debt driven, look at their liabilities, or equity driven, look at their shareholdings. You're just looking at a snapshot, rapid review. In the cash flow statement, you are looking at their cash flow from operating activities, investing activities. You're looking at their cash and cash equivalent if it marries with the SFP, cash and cash equivalent. So those snapshots are a skimming process you perform as you are looking at the financial statement very briefly. And that will help you in that rapid review. You are looking at the business by reference of these following criteria we'll be listing. You'll be starting by saying, what is the nature of the business? Where is this business domiciled? Which sector? Is it banking? Is it retail? Is it manufacturing? Is it healthcare? Which sector is their business? So that's part of your initial review. Number 2, is it an expanding or contracting business sector? Meaning expansion, you're talking of a business that has different branches, a head office and different centers spread across the location. Or a contracting business where it is franchised. So for example, like NNPC, they have a headquarter but franchised other outlets, retail outlets across the globe. So what kind of business is it? You're looking at the nature of the business. You're looking at recent events, factors that affect this company, changes in forex, exchange rate, and foreign exchange volatility, and all that. So is the business heavily driven by these forex issues? That's part of your initial analysis. What is the impact of technology on this business? Is the business technological driven or is manually driven? These are part of your initial analysis. Does electronic commerce affect this business? So, for example, like Jumia, Ponga, do the business do transactions online? Are there electronic data interface or interchange? So these are questions you ask in your initial analysis. You ask yourself, where is the business in its life cycle? So from the financials, is the business a startup? Is it growing? Is it maturing? Is it dying, shrinking, or static? So these are initial questions you ask as you go through the FS. The total business growth Or are there certain sections that are growing and some others are not growing? So you look at the conglomerate, if there is a holding or a subsidiary company, are there parts that are growing and some other parts are not growing? So is the business growing holistically or in silos? So you need to understand the section of the business, what is driving the business, and these are questions you ask initially. So is the company growing organically or by acquisition? Organically means it's ordinary course of business day to day, or is it a merged company or a target company that is driving the growth of the principal company? So these are questions you should ask as you're looking at the business initially. You also ask, is the company making good profits? When you look at its gross profit, operating profit, its bottom line, the net profit, is it making good profits or marginal profits? Is it making losses? How much? When within those financial years you've analyzed, maybe it's a 3-year financial, 5-year financial statement. When have they made losses? When do they make profit? So this is important to establish these answers in your mind as you are performing the initial analysis. Is the company performing stably or erratic? Stably or unstable? Spot of growth, or has it plateaued, as in stayed at a particular spot? So these are questions you ask initially on the stability of the company's performance, and that is from the income statement you establish that. Other questions are the size of the business. Is it a small, a medium, or a large company? Using the revenue criteria, the profit criteria, total assets, the net assets, which is the total asset less total liabilities criteria. So the size of the business is very important to ask yourself the question: is it small, medium, or large? Also, is it a single company or a group, or a national or an international company with business segments? Is it a holding company with subsidiaries? Is it a large conglomerate? These are questions you ask on the size of the business. Also on the size, is it a quoted company? That means a PLC, or an unquoted company, or a limited company? What are the volume of shares issued? Is the business stable or unstable? Critical questions you need to ask. Is it financially well structured? That means appropriate mix of debt, which is long-term and short-term debt. So is it appropriately mixed with debt and equity, 50-50, or debt is higher than equity, or equity is higher than debt? You need to check the financial structure or the financial leverage of the company. Is it solvent to meet, as in, is it able to meet its current liabilities? So you look at the current assets, less current liabilities. You look at the component of the assets in your initial review to determine the company's solvency. Also, with a good life expectancy, is it starting up, expanding financially, or declining? So you should be able to establish and answer these questions from your initial review. Are there any budgets or forecasts achievable or unrealistic in line with strategic direction? So from the study, from the case, you should be able to establish this if there are any budgets or forecasts given. What is the wider context? So aside financial information, the economy, is there recession or a recovery based on the context of the case? So you need to read the case and look at the wider context. What is driving the business and how is the economy impacting the business? Home-based, or is it involved in imports and exports? So these are questions you ask. Is it a locally product-based company or service-based company, or do they depend on import and export, and Forex will come in to drive the business? Also, the inflation, is it affecting the company, or stagnation in the market? Availability of finance, any banking constraints, no loans provided, no fundings, qualitative easing, interest rates that may hamper or deter them from borrowings. These are questions you ask initially. What is the fiscal policy of the economy, or the impact of fiscal policy driving the economy? Stimulation for investment, or are there any restrictions, any tariffs by government or quotas? These are questions you need to ask. So having rapidly conducted this initial analysis, you should have gained a comprehensive overview of the business and will be in a position to start to consider its SWOT, that it is financial strength and weakness. So it's important to make sure that from the beginning, you integrate your analysis, and therefore you should always be aware of the wider text. So not just looking at the financial information or the balance sheet or everything that generally impacts the company financially, the wider context and external factors, the external environment, inclusive of the internal environment which you are conducting your review, should be taken into cognizance as you are doing your initial review. So, for example, from the initial analysis, a business may appear to be growing and therefore succeeding. Maybe they are making profit year on, year out. Their bottom line is okay. But if you look at the economy in that period of strong growth, and this business is growing less rapidly than others, then it's probably not succeeding. So comparing it with its peers in that industry, it may be growing, but the peers are growing faster, rapidly than it, then it's probably not succeeding as well as it should, and the reasons should be investigated. So where its peers are performing at a particular ratio higher than it in the measurement of some particular categories of ratio, and it's performing lower than them, then it's not succeeding even though it's doing well. So in comparison to other peers in the industry, we need to ensure that the company you're analyzing is doing well in relation to the economy and in comparison with its peers. So try to avoid making generalized or final judgments from rapid first impressions. Exactly. So first impression may be deceptive, so try to avoid that and make sure from your initial review you take note of them, and it will spur you to go into your detailed review of the analysis. So the fact that the economy is currently in recession or experiencing a weak recovery is not necessarily the reason for poor results being achieved by the company you are analyzing. Exactly. So recession or depression may not be the reason for the company doing bad. There may be a more pertinent or potentially more worrying, alarming reason, which you must be able to identify during your investigation, and this will entail or be part of your detailed analysis. So that will be the end of initial analysis. And
it's long and very detailed. It's a lot.
It's a lot, right?
It's a lot.
Yeah, it is. I love it. It's practical. That's exactly what you do in the case study exams. I love it.
But we need to practice everything you've just said.
Exactly.
Okay.
Again, to practice it, yeah. So that's the initial analysis. Just ask some questions before you dive into the detailed analysis. And some of them are financial and some of them are the wider context. Okay, so do you have any questions before we move to
No questions.
All right.
Self-explanation.
Yeah, it is.
Well, it's a lot to sink. It's a lot to sink in.
Yeah. You have to go over it. After the class, I'll still share the slides. So you go over it again, look at the quiz questions as we've done that, and it will help you make it sink. Okay, so what is the primary objective of the initial analysis of financial statements? A, to prepare a detailed ratio analysis. B, to conduct an in-depth audit of the company's books. C, to establish financial headlines through a rapid review. D, to compare the company's performance with industry competitors. C. What is the primary objective of the initial analysis of financial statements? Okay?
Yeah.
Huh?
C.
C. Final answer, C.
Yes, please.
Fantastic. All right, we'll see. Which of the following is not a key area assessed during the initial analysis? Nature of the business, business life cycle, detailed financial forecasting, wider economic context. Which of the following is not a key area assessed during the initial analysis? Nature of the business, business life cycle, detailed financial forecasting, wider economic context.
Yeah.
She said,
Say, hey, God, this is confusion. Ah, D, please.
Okay, wider economic context. Final answer.
I don't know. Yes, final answer is fine. Yes.
Final answer D. Okay, we'll see. When assessing the size of a business in the initial analysis, which of the following factors is considered? Number one, product innovation. Sorry, A, product innovation. B, revenue, profit, total net assets. The number of employees only. Customer retention rate. When assessing the size of a business in the initial analysis, which of the following is considered? Product innovation. B, revenue, profit, and total or net assets. Number of employees only. Customer retention rate. What's your pick?
Which of the following factors is considered?
Yes, when assessing the size of a business in initial analysis, which of the following factors?
Of course, revenue, profit, and total net assets. Yes.
Okay, B, final answer.
Yes.
B. Okay. C. Why is it important to consider the wider economic context when analyzing a business? A, to determine the potential impact of external factors like inflation and fiscal policy. B, to focus only on internal financial metrics.
Economic context. So, hey, did I pick that one? Hey, I don't feel amo. Hey, I don't feel amo.
She remembered the question.
Chai. Hey. Hey.
Can you imagine? That's good, but it has gone. So you already know the answer now. Well, focus on this one and get this one at least. Why is it important? Why is it important to consider the wider context, economic context, when analyzing a business? To determine the potential impact of external factors like inflation and fiscal policy. To focus only on internal financial metrics. C, because the business is always impacted by the global economy in the same way. D, to avoid assessing company-specific weakness. Why is it important to consider the wider economic context when analyzing a business?
C.
Because the business is always impacted by the global economy in the same way. Final answer.
Yeah. No. A, sorry. That's A.
The potential impact of external factors like inflation and fiscal policy. A or C?
A, please.
Okay. So let's go back. Let me give
Yeah, I
you
don't
that
feel this one well. Okay.
Let's go back. Where was that question again? Okay, so
Number
I give you the privilege. I give you the privilege of number 2. So go over it again now.
Which it's not a key area assessment.
Analysis. A,
business life cycle.
Business life cycle. Final answer.
Yes, please.
Okay, you chose D before, so let me change it to B.
Thank you.
All right. Number 3, when assessing the size of the business, okay, you've answered this. Number 4, you've also answered, you took A. Number 5, what is the key risk of making general assumptions from a rapid initial analysis? What is a key risk of making general assumptions from a rapid initial analysis? It may lead to incorrect judgment without considering deeper underlying issues. It provides a full understanding of financial performance. It eliminates the need for further detailed analysis. It ensures all financial weaknesses are identified immediately. What is the key risk of making general assumptions from a rapid initial analysis? C.
I've been saying A itself. I don't know.
Final answer, C or A? C, it eliminates the need for further detailed analysis. A, it may lead to incorrect judgment without considering deeper underlying issues. I like this. I like these questions. They are tricky. This you will not score 100 over 100.
Oh, my kid.
Yes. What is the key risk of making general assumptions from a rapid initial analysis?
Yeah, say are the same thing now.
I don't know. And you can't
They're
pick
the
A and
same thing. It's the same thing. C.
You have to pick one. Okay, they are taking C.
Makes
Final
sense.
answer. Final answer.
Yes.
Okay. Final answer C. All right, drum roll. Let's see now. Number one. What is the primary objective of the initial analysis of financial statements? Exactly, to establish financial headlines through a rapid review. Yes, she got it.
That one was easy now. That was the first thing you showed us.
Okay. The initial analysis is meant to quickly assess the business by identifying key financial headlines and gaining an overall understanding before performing a detailed analysis. Exactly. That's good. Number two, she failed it.
Hey.
Out of the two, she picked D first, she picked B first, she still failed both of them. So the answer is C. Let's see. Which of the following is not? Yes, ma'am. You picked D first. So is that not that confused you? Which of the following is not a key area assessed during the initial analysis? We don't analyze detailed financial forecasting.
It was in my head, though. Detailed financial forecasting. No, no. It's not. It's not, oh. Hey, God, oh. It's not. When not comes into a question, it just throws me off balance.
I'm telling you, that's why you have to take note. So
it's not a key area assessed, really.
Yes, during the initial analysis. So initial analysis focuses on high-level financial assessment. High-level financial assessment, not detailed future projections. Forecasting is a more in-depth financial planning exercise. So let's see which ones you picked. You picked D, wider economic context. So factors like inflation, interest rates, and fiscal policy can impact a company's financial health and must be considered. Yes. You now picked B, business life cycle. Identify whether a company is in a growth, decline, or stable phase helps in assessing financial strength. So those are not the answers. So the answer is C. At least you didn't get one right. So even if you score the rest, I'll be happy. So let's go. Yes. Number 3. Yeah, she got it. When assessing the size of a business in the initial analysis, which of the following factors is considered? Revenue, profit, and total net asset. Exactly. So the size of the business is measured by financial indicators like revenue, profitability, and asset.
Hey, God.
So, okay. You already know. We have not done the other two now. How did you know you failed two? You failed only one so far.
Okay.
So we have 2 more. Number 4. Why is it important? Okay, you got this one. Why is it important to consider the wider context in analyzing the business? Yeah, so you get this one. To determine the potential impact of external factors. Nice one, like inflation and fiscal policy. Okay, that's good. A company performance can be affected by external economic factors such as interest rate, inflation, and trade policies. Good one. Okay, so finally, let's see if she got this one. She failed it.
I said it's either A or C. It was A or C. It was C, and the answer is the same. It is the same. It is the same, honestly.
Oh yeah, let's see now.
It's the same line. It may lead to incorrect job because without considering deeper underlying issues. C. They made the need for further detailed.
It's not the same.
It's the same thing. It's the same English.
No, it's not.
It's the same English.
This one is saying it may lead to incorrect judgment without considering deeper underlying issues. And the explanation is that rapid reviews provide a broad overview, but may miss key details that require a deeper financial assessment. Now, this one says it eliminates the need for further detailed analysis. Detailed analysis is necessary to cover underlying financial strengths and weakness. So they are different. So this option is speaking to further detailed analysis, while this one is saying risk assessment.
Almost.
You almost. And you said A or C, but you didn't know which one to pick.
Mm-hmm.
So from 80%, she slid down to 60%. That shows I'm teaching good. Yes, I'm a tricky teacher.
Well, somehow when you feel something, when you feel something, you don't forget.
Forget it, yes. That's one good thing about it. Mm-hmm. Like me now, if I feel that option, I won't forget it again. Anywhere I see it, I always remember. Okay, that's fine. I'm glad you have 80%, 60% understanding of steps and initial analysis. That's good. So we have 8:51. Do we go on break or we should take detailed analysis? Yes, it's
Let's take detailed analysis. Let's take detailed analysis.
Okay, let's take detailed analysis. That's fine. Then we'll go on break. All right. So detailed analysis. So after initial analysis, the next step is detailed analysis, which is conducted on financial statements. So after we've done our initial review, we'll now do a detailed review by examining and explaining the information provided in each of the key documents, together with the detailed note to the account. So what are the key documents? We have the statement of comprehensive income, statement of financial position, and the statement of cash flow. So he features the first two only, but three of them are what we should be analyzing. And we'll break down this detailed analysis into individual components. So number one, the income statement, including the statement of changes in equity. So the questions we'll ask is, how is the business performing? So from the income statement, which is a performance review, the income statement looks at the performance position of the company, while, okay, let me don't say what the statement of or the balance sheet looks like, but the income statement looks at the performance position of the company. So what are the key elements of the results in the income statement? Number one, the revenue trend. The revenue trend in total and by stream. So what are the revenue trend? So for example, 2020, 2021, 2022, what's the trend? Is it up or down? What is this stream? So the revenue stream, do we have different streams? Revenue from products, revenue from services, revenue from manufacturing, whatever the streams are, you need to analyze them. And what is the sales mix? What are the products they sell, and what are the mix, the combination of goods or services? Related costs. What are the cost of sales? Looking at the purchases, the manufacturing, closing inventory. So what are the related costs in that first line cost component? After that, what are the gross profit? Is it going up? Is it coming down? So after deducting admin and distribution, what are the operating profits? So these are detailed reviews now you're performing. And overall, after the operating profit, you look at your expenses that has to do with debt, whether you have finance cost or finance income. And after that, you deduct depreciation, amortization, taxes. Then you come to your overall profit. Are there overall profits or losses, surplus or deficits? So these are things you analyze in the SCI. So the income statement analysis is further developed below. So you look at the statement of financial position. Now the statement of financial position look at the position of the company, asset-wise and liability. So the capital of the business, is it debt or equity-driven? The assets of the business, the liabilities, which ones are higher? Is the business financially stable? Establish its financial position by analysis of the statement of financial position components, which includes total assets. What is the total asset? Looking at current and non-current. We're doing a detailed review right now. And the net asset, looking at total asset less total liabilities, total asset less current liabilities. Then what are the net current assets? everything that helps drive solvency, day-to-day operations, gearing, capital structure between equity and debt. You're asking your questions and looking at the numbers, which ones are influenced by which, what are the quality of the assets, the PPE and the current asset, what is their quality, the nature of liabilities, and the statement of financial position structure. So we're looking at this graphically from the statement of financial position. So we're to consider these main components. Number one, the current assets, current liabilities. Number three, the fixed asset, which is our non-current assets. And we're also looking at equity and debt. And the debt has to do with non-current liabilities or non-debt items like deferred tax or other non-debt items in the SFP. So you need to consider these main components when you are doing your detailed review. Now, an analyst or a good candidate is particularly concerned about any shortfall between the amount invested in number three, which is non-current assets. So as an analyst, as a case study candidate, you are looking at the non-current assets and their financing, which is the long-term funding. So are they funded by equity or they are funded by debt? Very important. So you need to look at that in analyzing your financial statement. Is the non-current asset the fixed asset that is a long-term investment? Is it funded by equity or is funded by debt? Because this means dangerously that non-current assets are being funded by short-term finance is dangerous. Very, very dangerous for the company. So if you are funding your current long-term asset from current asset, which includes inventory, receivables, cash that is supposed to be day-to-day, and you are buying fixed asset with it, then it's dangerous for the business. So funding long-term assets, non-current asset, fixed asset with short-term finance is very, very dangerous. So take note of that. How do you fund long-term asset? You fund it by long-term finance, equity, or debt. That is very important to take note. So funding long-term assets with short-term finance that you are supposed to run the business on a day-to-day basis is highly risky. This is key. Okay, so the statement of cash flows now you are looking at is the business using or generating cash. Is it using cash or generating cash? To what extent? Then the question is why? What is the relationship between the operating results and the cash generation and usage? So the cash flow is where he has not tested. So please take note of this in the detailed analysis in case he tests it. Always remember the interconnectivity between the three statements, which is the SCI, the SFP, and the SCF. So the interconnectivity between the income statement, the balance sheet, and the cash flow statement, and these bridges, they have three bridges. There's a bridge that links three of them together. You have to take note of them. These bridges includes items such as closing inventory, including work in progress, depreciation, amortization, impairment of assets, deferred income and provisions, such as impairment of accounts, receivables, and doubtful debts. So these amounts are touched or are linked to all these three financial statements. So, for example, inventory is in your cost of sales, the beginning and the closing. Inventory is in your balance sheet as current asset, and inventory is also in your statement of cash flow, in your cash flow from operating activities. So these bridges, there are some items that are pertinent and they feature again and again in each of those financial statements. The same thing for depreciation. Depreciation is in your expense. Depreciation is also in your financial statements. After you've done your fixed asset, you have to deduct accumulated depreciation, and also depreciation is in your cash flow statement. So these bridges and all these items listed here are in those three statements. So knowing how the movements are and how they feature in these financial statements is very important for an analyst to take note. So all these bridges affect reported profit, but candidates in the case study should always consider the impact of changes in these bridges and evaluate the related assets shown in the statement of financial position to identify materiality. This is very important. So the material amounts and how these amounts influence decision making and their size is very important in your analysis. So in analyzing these three key documents, SCI, SFP, and SCF, you need to break your analysis down into individual components. The specific questions that you need to ask and be able to answer are detailed in Module 4. So, Module 4, which topic again is Module 4? Module 4 is business strategy, if I'm not mistaken. Analysis of business strategy. That is Module 4. Module 3 is financial data analysis. And Module 4 is business strategy. So, in business strategy, we'll be looking at how to break down these documents individually in our business strategy analysis in Module 4. So we'll look at that in Chapter 4 as we go on. So that will be it for business analysis. And I don't know if you have any questions on detailed analysis.
So,
Okay, you're welcome, Salmat. After a long while, you're welcome.
Thank you, sir. This period is not easy for us.
I understand. How is fasting?
Fine, sir. Thank you.
Yeah, fasting and work is not easy, I understand. All right, nice to have you. So we are having a nice time with
Thank
Julie. We finished the computational aspect.
Good evening. Oh, yeah, me,
You sound
when I saw
tired.
this, I was like, what are we? I just want to sleep. But when I saw this thing, I was like, I cannot miss this type of class. Like, so what are we analyzing? I don't understand. I don't know why we're doing it.
Yeah, so we are done with the ratio analysis. Yeah, we are done with all the computation. So we are speaking to the numbers now, how to analyze financial statements. Yeah, so this is the main crux of the matter, how to analyze the financial statements and write on it. So we just did initial analysis now. We're looking at detailed analysis. And after the test, we are going on a break. So you just joined the test now, even though Julie is doing very well in the test. So you just doing the test. You're just doing the test now.
Which
Then
test are you doing?
yeah. So after each section, after each analysis, we'll do a 5-question test to test if we really understand what we just spoke about the lecture. So it's an OBJ, just multiple. Yes, it's multiple choice. So it helps us remember and reminisce over what we are working on.
Oh, okay.
Yeah, so we just did detailed analysis. So maybe you do guesswork, but then Julie wants to score 100 over 100, and I don't want her to score 100. She's always scoring 8.
You know,
I scored
now.
60. I scored 60.
She has not scored 40. Even in audit, she has not. The least she has done is 60. And me, I want her to come down so that I'll feel good, you know. But she's doing good. She's really doing very well. But then let's see, maybe she will come lower in this initial analysis. Okay, so let's go question 1. So let me put Salmat on the current list now. So we have J and we have S.
Okay, sir. Are we going to call the answer out?
Yeah, so you just mentioned the option, then I'll write it down. So when we are looking at the answers, we'll now see where we made mistake, why is correct and why is not correct. Yeah. All right, so let's go. Number 1, which financial statement helps assess whether a business is financially stable? This one is simple now. Okay. A, income statement. B, statement of financial position. C, statement of cash flow. D, statement of equity.
Am I in B?
Who is going for A? Who is going for B? J went for A. S
went for B. I went for B.
J went for B.
Okay, J went for A.
No, I went for B. Me and B. J went for B.
J is B. Okay, S went for A, number 1. Final answer.
Yes.
Are you sure that's your final answer, both of you?
Yes.
Financial statement.
Which financial statement helps assess whether a business is financially stable? A, income statement.
That
B,
is B.
statement.
Let me B because that's where you will see.
Final answer to B. Are you sure you are changing from A to B?
No, I'll stay in my A.
Are you sure? Final answer A.
Correct my
You are free to change, and you are free to go down to C or D, anyone.
No, it's A.
Okay, you are staying with A. All right, J said B. Okay, we'll see. In financial statement analysis, which key element is not typically examined in the income statement? A, revenue trend. B, sales mix. C, quality of assets. D, operating profit. In financial statement analysis, which key element is not typically examined in the income statement?
Not typically.
J, final answer C.
C.
S, what's your answer? So you were not in the class, you will have to guess because this was in the lecture practically. In financial statement analysis, which key element is not typically examined in the income statement?
Sales mix. B.
Okay. Final answer B.
Yeah.
Okay. Final answer B.
I see.
Final answer for JC. All right. What is a major concern when non-current assets are funded by short-term finance? This one, J will get it, I know. Increased revenue, financial stability, higher profit margins, lower depreciation cost. What is the major concern when non-current assets are funded by short-term finance?
B.
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 S to B. Final answer, both of you. B.
Yes.
Okay, we'll see. Let's go. Number 4, which of the following serves as a bridge between the income statement and the statement of financial position? A, closing inventory. B, sales revenue. C, net cash flow. D, capital structure. Which of the following serves as a bridge? Okay, S is saying net cash flow. All right. Final answer, C for you, S.
Yes, sir.
Are you sure? Or you just guessed? J, what's your pick?
Income statement of financial position. Wait.
I think it's A.
Sir, wait, that's not my final answer.
I think A.
J is thinking A. J, final answer A. So S is
bridge. As in bridge, they're joining them together.
Exactly. A is not agreeing for C, so
Actually, it's not net cash flow. It's even no separate. I'll pick my C. I'll stay with it.
okay, S is staying with. J, what is J? J, what are you staying with?
Accounting is too technical.
Because that sales revenue is not capital structure, bridge. As in the similarities. Those are bridge.
What connects them?
What connects them?
Exactly. J, final answer A.
Closing inventory connects them.
Closing inventory connects them. But I know closing inventory is in both of them.
Current assets now.
It's in both of them.
But closing inventory is actually in your statement of financial position.
It's what? It's in both of them.
You people are doing group assignment too. No
okay,
group
sorry.
Assignment.
Sorry, sir.
I take A.
Who is taking A and who is taking C?
J
for A.
J is taking A.
J is
then
taking
S.
A.
S is taking.
Yes.
You are staying here with your C. Okay, so no group assignment, or else I will penalize you people. I will deduct some percentage from your answer.
Okay.
So finally, All right, finally, what key question should an analyst ask when reviewing the statement of cash flow? Is the business using or generating cash? What is the company's gearing ratio? Are the assets correctly classified? What is the profit margin trend? Number 5, what key question should an analyst ask when reviewing the statement of cash flow? A, is the business using or generating cash? B, what is the company's gearing ratio?
My answer is A.
Okay. S is A and J is A. How comes both of them A? Okay, final answer A. Are you sure? Final answer?
Yes.
Yes, sir.
Okay, fantastic. Let's go. Drum roll, baram. Number 1. Which financial statement helps assess whether a business is financially stable?
B.
All right, the answer is B, statement of financial
Which
position. This statement,
financially stable. Oh.
yeah, statement of financial position. So for income statement is incorrect because income statement focuses on performance, not position. Yes. So you can see the statement of income focuses on performance over a period, showing revenue, expenses, profit, but does not fully indicate financial stability. So the statement of financial position provides a snapshot of the business financial position at a given point, showing assets, liabilities, and equity. It helps determine financial stability by assessing net asset, capital structure, and liquidity. So J is correct, B, and S is not correct. Okay, so 1. Yeah, so let's go. Number 2. In financial statement analysis, which key element is not typically examined in the income statement? Yeah, so J got it. C. So J got it, and you picked B. You said sales mix, so that was incorrect. So it's not sales mix because the income statements break down different revenue streams, making sales mix an important element of analysis. Exactly. So J is correct because quality of asset quality is analyzed under statement of financial position, not income statement. It refers to how valuable and liquid assets are, including the risk of impairment or depreciation. So J has scored 2 now. I'm afraid she's doing well. All right.
Let's see.
Okay, number 3. What is the major concern when non-current assets are funded by short-term finance? The answer is not A. The answer is B.
It's B. I got B now.
Yeah, so even S2 got B. S2 said B. So both of you got it.
Yes, now.
Yeah, so
yes, because
what
you
is the
cannot
major
be
concern?
using.
Yeah, go ahead. Go ahead, please. You're saying something.
Well, I said because you cannot use short-term finance.
Exactly. You're correct. So yes, exactly. So financial instability is correct. When long-term assets like building or equipment are financed with short-term liabilities, the business may struggle to repay its short-term obligations, leading to financial risk and stability. Exactly. So the major concern is financial instability. So both of you got it. Yeah, so both of you got it. Good one. Okay, Julie is going. At least Almat has scored 1. Julie is just scoring everything 3, and I'm beginning to.
Thank you.
All right, so number 4.
Hey,
Julie has gotten it again. Julie has gotten it again. Hey, 4/5.
Hey, okay.
Something has to stop her. Which of the following serves as a bridge between the income statement and the statement of financial position? Closing inventory, exactly. So inventory appears as an expense in the income statement. Yes, cost of goods sold. So you have that opening inventory, purchases, closing inventory, exactly. And it appears as current asset in the statement of financial position. And it also appears as changes in inventory level in the statement of cash flow, making it a key bridge. That's correct. Nice one, Jay. Then S said C. S said C. So C is incorrect because cash flows affect financial health. They are reportedly separate in the statement of cash flow, not as a bridge between the two statements. So net cash flow is not correct. All right, let me hope Jay will fill this one. Number 5. She got it. Oh my God. She got it.
Hey!
She got it.
I'm angry.
She has scored 100 over
Oh my
100.
goodness,
I
And
knew
I'm
we were
not going
going
to
to
number
get this
5.
one.
and I'm not going to sleep very well tonight if she scores. She has
You have
scored
to
100
be
over
well. You have to
100.
be proud that I'm stepping up.
I'm telling you, how can she have 100% understanding of detailed analysis? That's incredible. That's very incredible. I like that.
Correct.
See S that just came. She didn't even attend. S that came and didn't attend lecture. She's scoring 20. That's good though.
She tried now.
I didn't even expect her to score anyone, self. She just came for this thing. She didn't attend lecture and she has scored 20%. All right, Jay, congratulations.
Thank you.
You decided to beat me, very hands down, no problem. Nice
When
one.
I'm going to start writing.
Now.
Yes, sir. When I'm
You
going
said
to
what?
start writing. When I'm going to start writing.
Writing what?
Writing reports apart from the assignments.
Yes, so our
What's
next
it?
our next mock is coming on Friday. In fact, your scripts, I'm currently marking your script. So you should get your script before Friday and the next mock is on Friday.
I have a challenge,
Yeah.
Like executive summary is from requirements, right?
Exactly.
Then the other two in between executive summary and requirement is background and limitation, Abi?
Yes, exactly.
I am not comfortable with. I don't think I really think about background in that mock and limitations. I don't know what the contents are meant to be.
Yeah, the content
and the limitations.
They are directly from the exhibit, so you just copy and paste. The background is in the exhibit, yes. Then the limitations are just the. Yeah, sorry, Salma, you were saying something. Let me hear your thoughts.
No.
Okay, I thought you were trying to speak to Jay's question. Okay, so
limitation basically
is
like what hindrances. So I think it's always like when you don't have complete.
Is she talking to us?
Yes, we're struggling to hear you. You're not close. You're not close to the mic. You're not close to the mic. We're struggling to catch your thoughts.
Like complete information on like you don't have statement or certain information was not given, so it's like it has limited you from having a complete report, sort of. I don't know, but he will tell us. But I think that's what limitation basically is.
Exactly. I think I agree with her. But then another part of okay, go ahead, Julian.
I'm asking what she say.
Yeah, so she said that any hurdle you encountered during the financial statement case study analysis is a limitation. So, for example, for most of the times, the examiner provides income statement and statement of financial position, but he didn't provide cash flow statement. So that's like a limitation. And if you don't have projected financial statement, is a limitation. So, for example, the scope maybe a 3-year financial statement, 2020, 2021, 2022. So what of the start of the business and when the business grew? They just gave you 3 years. So you are limited to those 3 years.
Okay.
Yes, so anything that limits you within the scope and your study is a limitation. So you don't have budget to compare actuals is a limitation. So you don't have projected cash flow to compare what you have. You don't even have a cash flow statement. Those are limitations. So just list them. Anything that impedes, like Salman said, anything that hampers your study, it's a limitation. So it just looks like 4 or 5. Limitation and scope is just 2 marks. There are 4 marks, both of them.
Limitation and scope. Are they one? Okay, I know there's cover page, then executive summary. After that is background, Abi?
Yes. Background, then limitation and scope on the same page.
Limitation and scope are the same thing. Okay.
Yes.
Then
yes,
after that, you have when you have outline, course, what do you call that then?
yes, report
Where you have
outline.
it, report outline.
Yeah.
Is it after? It's supposed to be after.
like your
Is it after executive
content.
summary?
No,
Exactly. Is it after?
I
It
think it
should be
comes after
before.
limitations. It comes after limitation.
After limitations, okay. Then after
Yeah.
that, you have requirement 1, requirement 2, right?
Yep. Yes.
Then after that, you have appendices.
Exactly.
And that is what we have been doing since the appendices, trying to get the analysis, ratio analysis. Yeah.
Yes, that's true. That's
Okay.
true. So let's validate that by looking at this very practically now, because you just drove us to something that wants to make you remember. So if you can look at my screen now, so you can see the format. Have I shared this with you?
Yes, you shared this, but sometimes it's good to remember offhand,
Oh,
offhead,
okay.
Oh,
and
Yeah.
offhand.
I have in the class then. I don't have to.
Start paying executive summary. We should even know the contents of all of them, so to know how to
Exactly.
write it.
Yeah. So it's good. So when you are practicing your mock, you just do it off heart without
Good
looking at
like that.
this slide.
Yes.
Yes, without looking at this slide. So the introduction and background, you see where your report outlines come. It comes after your introduction, background, your report outline come there, your scope and limitation. So everything on this third header is about 4 marks. So when you are practicing, I believe as you do 1, 2, 3, you'll just remember this very, very vividly. We have not gone on break. We have spoken for
It's true.
over.
We have to go on break.